I am mining investor and editor of Resource Stock Digest, Gerardo del Real, here with my partner, Mr. Nick Hodge, who's also an investor and publisher of Daily Profit Cycle. I laugh now because this would not be the happiest of podcasts because the boogeyman is back, y'all. This is the 318th episode of our weekly therapy session that we like to call Investing in Bizarro World. We're going to talk markets, what we're investing in, and yeah, we're going to talk about the boogeyman. It's not me, folks. I missed last week. I missed y'all. I'm energized. I'm worried. We'll get to all of that, but first and foremost, Senor Hodge, how goes you and your beautiful family, sir?
Don't you bring me down, Gerardo. I'm feeling pretty good this week. We're doing good. We're preparing for a long Memorial Day weekend and then a Disney trip after that. Don't tell the kids. It's a surprise. And so I'm doing all the things, trying to get all the things ready for that time out of office. How are you doing?
No, look, jokes aside, I am excellent. Health-wise, I'm great. My wife gets prettier by the week. She still loves me. The kids are healthy. Our middle child, we just returned. I missed last week. We were in just outside of Philadelphia. Our middle child graduated from the university. So super proud parents. Ceremony was beautiful. The weekend was great. My sister came out. My brother came out from DC. It was great to be able to celebrate, his 4 years of effort and the accomplishment, and curious to see where he goes next. So I say all that to say that personally, I am extremely well. Financially, I feel positioned perfectly for the boogeyman, for the thing that has me worried. And I wrote about it earlier for Daily Profit Cycle, and y'all can go to dailyprofitcycle.com/subscribe every day and then get free editorials from myself, from Nick, from our talented staff that's over there, Chris Curl, and then the many people that, cover different sectors, everything from crypto to tech to the resource space, which is exclusively what I dabbled in, to anywhere there is to make money, which is exclusively what Mr. Hodge dabbles in. But, what I wrote was, I've seen this before, and I was much younger, obviously. This was the mid-90s, but I don't fancy myself a student of history, but I most definitely pay attention to it, and I do dig into it. I do have a fascination for it. And as the old saying goes, it doesn't repeat, but it sure in the hell rhymes sometime. And it's starting to rhyme in a very loud way in my wonky brain. And so I'll tell the story that I told in the editorial this morning. Back in 1994, a young, handsome, dashing, charismatic Bill Clinton came into office, right? And, he came into office with overwhelming support, a la Donald Trump, who wasn't young and dashing, but, absolutely came in with the mandate, right? And so Bill Clinton had a lot of political leeway to implement the things that he wanted to implement. And sure enough, a little bit after getting into office, the bond market, the bond vigilantes, the boogeyman, came out. And what started happening is the 10-year Treasury went from 5.2% to over 8% in a 12-month period. Now, there is a reason why the 10-year being closer to 5% every day scares the heebie-jeebies out of everybody. Because the last time this happened, it took 1 year. It took roughly 12 months, 13 months to be exact, for it to go from 5% to 8%. We have $9 trillion in debt that we have to refinance this year. We didn't have... What's that?
Is that all?
That's it. That's it. With a T. We didn't have that the last go round. The other thing that we didn't have the last go round was an administration that was willing to introduce a big, beautiful bill that adds trillions to that deficit. What we had back then, and this isn't a partisan thing. I don't like either party. I've been very clear about that. But what the Clinton administration was correct in what they did. What they did was they cut spending in a significant way. And they went out and started making sure that the bond market and the administration's goals were in line. Because when you have a bond market that doesn't believe you're going to rein in spending and simultaneously believes you're going to give tax cuts to the rich and the corporations, the way this administration has indicated it wants to do, and oh, by the way, the administration also has indicated that it is willing to oust people within its own party. Massie is one of the most popular Republicans amongst everyone, amongst Democrats, amongst libertarians, and amongst Republicans, because agree or disagree with Mr. Thomas Massie, he's a man of conviction according to all three different parties. He's a man that understands math and deficits and history. And again, whether you agree with all or none of his political views, he at least stands on them and backs them up logically and factually. This administration doesn't like that. So they're threatening to get him out of there. And I've seen a lot of people on X, formerly Twitter, that lean very right, that are straight up, that were very supportive of Trump, straight up calling him out like this is absolute BS. I don't want to curse that early into this thing, but this riles me up because this is serious for everybody that doesn't dabble in the backyards and sandboxes that Nick and I dabble in. We're positioned perfectly. What's happening right now is you have a dollar index below 100. That's the Fed and the administration trying to get it below and make it look like the yields aren't increasing. But while the dollar is devaluing, the yields are rising on the 30, on the 20, on the 10. That is not sustainable. And if that doesn't get reined in here shortly, we're going to have a market dislocation. There's a reason why gold, and yes, even Bitcoin. And again, we offered y'all a webinar about a month or two ago with Chris Curl when Bitcoin was like at 75,000 or 80,000, imploring you that if you were in the crypto space or in the Bitcoin space, you should have been buying that pullback. He called that beautifully. I flew him out. We flew him out here and he walked me through it at my house and we did a whole like little mini seminar thing on it. I say all that to say that the reason that hard assets like gold and Bitcoin are surging, despite the fact that yields, or because of the fact that yields are going higher, is because eventually what's going to happen is what happened today. Today is a small window into what the next 12 months could look like, folks. The overall indices selling off sharply as overpriced equities, especially in the tech sector and the sectors that historically are still very overpriced, as money comes out of there, and there's a lot of capital in those sectors, be absolutely clear, and doesn't go into the bond market. We had a horrible bond auction this afternoon. It's why the market went from kind of flattish to, fuck, we're down 700 points now, right? Money comes out really quickly when big capital believes there's a dislocation that's possible, or believes they're not going to get their capital back, or they're going to get a lot less capital back, which is kind of the same thing. Gold is going to be a huge beneficiary. Anything that requires labor and expense and effort, copper, Bitcoin, I mean, that's not my specialty, but I listen to Chris on this stuff. It's going to catch a bid. It will continue to catch a bid. The equities by default will play along for a while, the ones that are exposed to it, because the Agnicos of the world that are responsible miners that have a phenomenal balance sheet are going to take advantage of that healthy balance sheet and rising prices and margins to go out there and accumulate more gold resources and more reserves to replenish their depleting reserves. So the market setup for me is beautiful. Man, if you're depending on a 401k in the next 2-3 years, I am fearful for people. And I hate being the alarmist, man. You know, I'm usually the optimist, but it's clear as day to me now. And the only reason I hadn't done an editorial like the one I did earlier, or a podcast this passionate about it before, Dalio said it a couple weeks ago. Buffett has said it, you know, Paul Tudor Jones said it. I was waiting to see what the bill that the Republican administration was going to present. Because again, my optimist self, I'm like, well, maybe I'm hopeful. And then this morning we get Elon Musk saying, I don't think I'll be spending any money politically anytime soon. I went in with a plan and we wanted to codify the spending and I wasn't allowed to do that. And so at that point, I understood that I was going to be ineffective. And make no mistake, Mr. Musk is the only one that played three-dimensional chess there. I believe he wanted to make the cuts. I believe he was told no. And I believe when he was told and showed the door, he said, cool, let me get these lawsuits off my back. Let me get these government contracts locked up. And let me at the very least get some of my money back for my shareholders. And let me go back into the private sector and do what I do best, which is put people into space, go pick up astronauts, make satellites to where your porn doesn't have to buffer if you live in the country, like all those things that he does very, very well, right? He played that really well. That is three-dimensional chess. He pivoted beautifully. But I actually believe he intended to go, and I saw that interview, and it was somber. Like, you could tell he was disappointed that he didn't get the opportunity to make the cuts that he wanted to make. And so none of that makes me feel good inside for the average Joe, Mary, Jose, Maria that works their ass off, that has worked their ass off for 20, 30, 40 years, that's counting on a pension or a 401k or dividend income from a fund manager that has promised that the stock market will never break. I am fearful that those people are going to be the ones that really, really get left outside, and maybe in a very literal way.
I mean,
sorry to take up all that time.
That was awesome. No, I was going to say, like, you know, you checked it down. I mean, all the things. I don't have a ton to add to that. I would maybe split it into two things, like this larger, bigger, not quite esoteric because you can grasp it, but this big debt looming problem that we have, right? I know you and I both spoke to Mr. Rule in the past week. You talked about the debts that need refinancing. He's routinely talking about the on-balance sheet liabilities, right? The 36, 37 trillion. And then he's also talking about the 100 trillion and off-balance sheet liabilities, the promises we've made to people that the government doesn't want to rein in. And it's not just the capitalists, the market guys saying this now. It's not just the Dalios and the Paul Tudor Jones, like you said. I mean, Moody's downgraded the U.S. credit last week, and we're not even talking about that anymore. It's like one of those things. It's like, phases of depression, right? It's like we're in denial. We don't even want to acknowledge that the debt and the deficits are so bad that we literally can't address them. And so the IMF also came out, I think, in the past week and sort of told the U.S. it needs to get its fiscal house in order. And you and I had been saying since October, I remember presenting at the New Orleans Investment Conference when the first week or two Doge was around, saying like, nah, man, like that's not going to happen. It's
Yeah.
the obligations are too big, the debts are too big, the interest to service the debt is too high, and we just don't see this going the other way. And then, for the first half of this year, you had the offices out there, a committee for a responsible budget, and on, saying that, Trump was going to run up the debt and the deficit. And I was saying, and you and others, that, of course, that's what he did the first time as well.
Yeah.
I would reiterate that he wanted his name personally on the COVID stimulus checks.
Yeah.
I mean, that's when all this started. That was half a decade ago. And so, no doubt that the Doge wasn't going to do anything. So, on and on and on. That's the reason countries are diversifying away from U.S. treasuries. It's the reason, Japan was selling treasuries this year and is having their own sort of bond issues. And at the same time, so that's the big part, right? That's the
Yeah.
big boogeyman. And then at the same time, on the more the micro this year level, it still don't see a recession materializing. Do see us getting back to growth, which could be another reason that bond yields are going up. Bond yields go up when you get growth, right?
Yep.
And you're going to get the inflation turning around. So we had this disinflation, for the first half of the year. Trump is claiming victory. The gas prices are so low. The egg prices are coming down. And yes, that was true, but of course not because of anything he did. Those are just macroeconomic disinflation factors, right? And we got this hand wringing about, are we going to have a recession? And I was telling you, no, in the second half of the year, we're going to get back to growth, and we're going to get reinflation. And so, it's funny how the macro market sort of, front runs whatever happens in the international and in the actual markets. Like, you had oil starting to tick back up last week, and then all of a sudden Israel's going to bomb Iran, right? And so, then you get that higher oil price. You had copper come down from $5 to $4 in the first week of April when we had that lovely party in the Rose Garden, the Liberation Day, I believe it was. Copper went down to $4, and it's now starting to reinflate. The same thing with uranium. Now it's $72 a pound, which was down around $63 or $64 a pound. And so I'm with you. There's large structural issues, and more people are getting it. You mentioned a few. I just mentioned some regulatory bodies. You can sort of sense it in the air. And then you've got people back in Massie, like you said, like people who actually get it. The Pauls, the Ron Pauls, and the Rand Pauls of the world, the Justin Amashes of the world, saying that, of course, Trump wants to get rid of the Massies. There's a reason he's installed the people that he's installed. I believe the phrasing he chose was he chose them because they're spineless sycophants. And a sycophant is someone who's an ass kisser, essentially.
Yeah.
Will do whatever the boss says. That's people like Kristi Noem and others, right? Kash Patel. So that's about all I got, but I'm with you. Agree that we're positioned perfectly. Agree that gold looks really good. It maybe can do a little bit of consolidating. Maybe wants to do that around 3,200, 3,250. But what really tells me that people are starting to get it is the Bitcoin. And, and because for the next generation of gold bugs, they're still crypto soldiers, right? They haven't quite come to the precious metals yet, but they're buying this Bitcoin for the same reasons that we buy the gold, right? I won't have to list them all out. You know what they are,
Yeah.
but Yeah, I mean, you got Bitcoin back at 107 or 108,000. So interesting times. I too feel like I'm positioned well, and I don't want to give all away all my talking points, but for the first time in a while, I was looking at my warrant portfolio and I was like, oh shit, I got to come up with like I should come up with some cash to exercise some warrants, right? So just speaking of being pretty well positioned.
Yeah. Let's talk about positioning for the next thing. So to be clear and to summarize, folks, you absolutely should have exposure to gold, whether it's whatever risk tolerance you have. It could be the juniors, the explorers. It could be an ETF of producers. It could be specific stocks, like the way I like to position, mostly on the exploration side. Different risk tolerances and different timelines for everybody. Know your risk tolerance, know your timeline. It's going to be critical over the next 12 to 18 months, not just for avoiding, the evaporation of wealth and money, or if you don't have wealth and a lot of money. I've been there before. I've been broke. I have a little money. Can preserve my little bit of money, right? So whatever you have, position yourself accordingly on that. That is the now play, and that is a play that we've been positioned for years and have made really, really good money on for the last couple of years. And I suspect we'll continue to, knock on wood. The next leg up, again, I got to talk uranium, and I know you want to touch on rare earths. Uranium has presented you a gift, specifically the equities, right? The spot price continues to tick back up again for the second week in a row. The equities are starting to catch a slight bid, but they're still trading, way off of 52-week highs and closer to 52-week lows and 52-week highs, which eliminates a lot of the risk that's inherent in these stocks, especially in the bigger liquid names. If they're operationally sound, if they're permitted, and if they're in great jurisdictions, you have an opportunity right now to add some names that are going to do phenomenally well in the next leg up, if you're willing to give yourself the time for that uranium spot price and the overall sentiment to improve. Any thoughts on uranium?
Yeah, I'm going to share a chart first, then I'm going to give you a couple of thoughts. Can I do it here? Yes, I can. Just look at this line here on the chart. It's at $72 and how it lines up with the huge cup you see on the thing. So we had the overshoot, as uranium tends to do, late 23, 2024. It shot all the way to about $105 a pound. And then it disinflated. I don't want to say sold off. I want to keep this in terms of inflation, because the fundamental bull case for uranium and nuclear never went away. It's still the cleanest source of baseload power. The world still needs it for clean electricity generation. The Japanese are still embracing it. The Chinese are still building out their nuclear fleet. The U.S. still needs 50 million pounds a year and only produces one. All the things, right? None of that stuff went away. The AI data centers still need it. The small modular reactors are still coming, and yet the price got cut off at the knee from $105 a pound to, I think, $63 or $64 a pound. What you see it doing now is coming back up to that $72 level, and that's an important point. Look back in the 2011 time frame, and that became resistance. It broke through that resistance here in 2023, and is likely going to do so again here in 2025. And I would submit to you that once it goes through that $72 level, not a lot stopping it from going back to 100. A couple of other things have happened in recent weeks. So while the price was going down, it's funny how the news dries up when the price of the commodity isn't going the way you want it. It starts going back up, and lo and behold, you get some announcements, right? One from the Trump administration, fast tracking uranium projects in the southwestern United States. I have a lot more of that to go. Speaking of finding names that are worthwhile of owning. The other thing was the first utility in the U.S. applied for permits to start deploying SMRs. So the catalysts, the news catalysts, continue to pile up, and then I just went through the price action. And the third thing, going back to Mr. Roll, because I asked him about this a couple of days ago when I interviewed him, is uranium a contrarian trade, the whole victim contrarian thing? And he said, yeah, man, the retail folks threw in the towel. You had the uranium Twitter handles quitting Twitter and just bailing on the trade. He says, what those retail folks don't understand, and honestly, what I'm not plugged into as much is the term market, the contracting market, right? which the utilities are going to have to do in a big way. And you don't get to see those prices as much. And he's contending that, they're going to be at much higher prices than we're seeing now. And that's going to be the next driver, the next leg up for the uranium stocks. So a lot to like there that I just went through, plus the reinflation that I was saying. Like, don't discount like the macro forces on these commodities when inflation is going from 8% to 2.3%, which it just did over the past couple of years. Tough for commodity prices to go up. In fact, I would say commodity prices, it's almost the inverse of that. When commodity prices go down, I mean, they take inflation down. Those are the input prices from which the CPI is calculated. So they're going to start going back up, and inflation's going to start going back up. And I think it looks pretty good. I don't know. I don't have much more to say on uranium. I don't know if you do.
I think that's great. Two thoughts that immediately sprung to mind. Who doesn't like big cups, right? And the second thought that immediately sprung to mind is, and this is a sincere thought because I saw a lot of I mean, the X accounts, the Twitter accounts, the social media accounts that were quitting on uranium were long time bulls in a lot of cases with a big following. And it all happened like in the same 1 week, 2 week period. I thought they were trolling the market, but they haven't come back. Like, they weren't trolling the market. They seriously were throwing in the towel. And I think, look, folks, this is going to be a relatively shorter episode because really things are as clear to me right now as they have been in quite some time. Copper is entering a structural deficit in the second half of the year. The simple way of putting that is we're going to need more than what we're able to supply the market. That's what a structural deficit is. That's going to last for many, many years. We're going to make a lot of money with copper and copper equities. That's going to be a great trade. We're positioned well for it. Portfolios are lined up. Gold will continue higher. Silver, I can't leave silver out. It is again, and it's tried many a times to break 33, 34 and finally try to get above 35. We'll see if it does it this time. If it doesn't do it this time, it'll do it next time. Eventually, it will do it. So I don't want to overcomplicate uranium, the supply-demand fundamentals. And this is what I couldn't understand about the social media accounts that understood to a T what the fundamentals were, the supply-demand fundamentals are for the next 2, 3, 5, 10 years. I couldn't understand why they didn't have the risk tolerance or the patience to not care what the price was up and down. Like, I have homes that I own that I don't intend on selling anytime soon. Like, I'm talking like a decade or 2 decades or whatever, if that, if ever. I don't care what the price does today or tomorrow or even next week or next month or even next year or in the next 3 years. I care about having a structurally sound home that we can enjoy or that can provide, pleasant memories for someone else, friends, tenants, families, whoever. I care about that. I don't care about, the monthly price updates that, the realtors send or that Zillow sends telling me my home is up 6% or down 6%. I don't look at that and freak out and go try to find a buyer immediately. And so when you get into this game, folks, Warren Buffett said it best when he was talking about, him leaving this year and retiring. He said, if you can't, and Rick Rule has said this many a times, and I agree with both those gentlemen who are much wiser and much wealthier than I. If you can't take owning a stock that's down 50%, even though you know why you own it, you have no business owning stocks at all. And that I think ties into a question that you had last week in the premium portion of the podcast that we can get into here in a little bit, and we'll touch on it again. But yeah, if you can't do that, not only do you have no business owning a stock, but if you own a 401k, you own a stock. You have exposure to that kind of drop off. I've seen this happen in my lifetime. I saw it in 2008, 2009. I've read about 1987, right? I wasn't in the market at the time, but those are very real things that can happen with blue chip companies. Don't think that's only what Gerardo dabbles in, the high risk exploration juniors, or, maybe a smaller tech company that Nick may be onto that has a big moat, to use Warren Buffett's words, and a lot of potential. That can happen with your 401k, folks. And again, I am not one of those editors or writers or investors or speculators that likes to yell fire in the middle of a theater. I'm just saying be careful and know that we could be going into a situation like that. And I hope that's not the case. Like if copper never goes up another penny and if gold never goes up another dollar, believe you me, I will keep finding early enough companies and teams and assets to continue to make good money for myself and my family and my friends and subscribers. That's not changing, right? Knock on wood. Be careful what you wish for. $5,000 gold, $7,000 gold, $8 copper, $150, $200 uranium. It's going to be really good for me. I don't know if it's going to be really good for everybody.
$150,000 Bitcoin. Yeah, just two things to add there. The housing prices are going the other way. I don't know about Austin, but here in Spokane, which has been a hot market, they've definitely softened up. I'm sitting in a real estate office. I started leasing a new office downtown, and it's in a real estate office. And why do you think they have available offices to lease to someone like me, Gerardo? It's because the market's slowed down a little bit. And I've heard just some of the conversations in the 2 weeks I've been here about how, when you're in a rising market, you got to price ahead of the market, and you set your price above because
Yeah.
the prices are going up. And I heard a gentleman on the phone the other day talking to a prospective client saying, you're going to have to price it lower because when you're in a falling market, you got to do the same thing to the opposite. You got to price it where the market is going, and it's lower. And a couple of more things. I was talking to another buddy who's a mortgage guy, and he says he's got a large percentage of clients that are, they're stuck in 6% mortgages, and they're waiting for a refinance window that may or may not come with the 10-year yield approaching 5%, right? And so one more thing on real estate is a lot of Americans have their net worth tied up in their house, right? You read
Sure.
about these millionaires and how more and more people are worth however many figures, 7 figures or whatever. A lot of that is in their home. It's they're not able to monetize it, and it affects them dramatically and drastically when the value of those homes go down on paper because it zaps their net worth. You were talking about 401ks. Similar problem with 401ks is that a lot of folks are in target date funds or allocate to the bond market or are allocated to the bond market by their financial
Yep.
advisors. And when you've got bond yields screaming higher, that by definition means that the bond yields are screaming lower, or not bond yields, excuse me, bond prices are screaming
Prices.
lower.
Yeah.
So you could, in a very real way, if you're reliant on fixed income, or if you have fixed income and you're not aware of it, or you buy a target date fund and you don't know what's in it, you've got to, you could, like you say, take a haircut very quickly. And it's why, first of all, I don't do a ton of fixed income, because I'm a younger gentleman. But two, I'm not comfortable giving my money to someone else to allocate. I did that once or twice, didn't have a lot of fun doing that, right? So I can do it better on my own. I can click the button whenever I want it, and I watch it every single day. So, and shameless plug, if you don't, then that's what folks like me and Gerardo are for. You still don't need an advisor to give you a pie chart and allocate your capital. You can do that on your own and open your own funds and manage them with the advice of input from folks like you and I and others.
Yeah. And look, I'll add something to that. When it comes to, the money managers, the people that sit behind the Bloomberg terminal in the fancy office with the fancy suit, they're not in the jungle in Peru talking to the locals to test out the social license support for that company's projects or access where the drills are going to be coming through. Um, they're not, at the site visiting the crypto center to see, just how sustainable the power is and how clean it is and what that operation looks like. And so there's benefits. And in I'm talking our book now, of course, there's benefits to the way that Nick and I approach the market that Nick and I ourselves, as active as we are, we couldn't get the same benefits trying to audit a Whole Foods or trying to audit a Walmart. It's just beyond the scope of our influence and our network of contacts. But best believe if you write in about a Hannon or a Kingsman, and we'll get to that in the premium portion of the podcast, I got a damn material answer for you straight from the horse's mouth. Whether that horse lives on site, or whether that horse is the CEO and the board, or whether that horse is the largest shareholder that I just happened to have a 1-hour meeting with before I got on here. I know exactly where things are and how the sentiment is at the hour that you send me that email. And so that is another benefit to what Nick and I and what the Chris Curls of the world are able to provide that we couldn't provide if we worked for a bigger outfit or if we worked for someone else. It just wouldn't be possible, right? And I think in the market that we're in the market we're heading into, that is a distinct advantage that separates us from a lot of people, even frankly, at our level, Nick, that provide some of the same services that just aren't willing to write the check to have the influence to be able to get the chairman on the phone when there's a negative newspaper article or when there's a story in another part of the country that's conflated with your project. It has nothing to do with it. You being able to source that and making sure you're talking to the community liaison to get that feedback and that reassurance that no, business as usual here. So, yeah, look, we started this with the boogeyman joke. I think we've explained what the boogeyman is. The boogeyman is the bond market. Every one of you that has any kind of money in the market should be watching 10 years, 20 years, and 30-year rates. The higher they go, the more problematic it's going to be. Watch for weekly auctions. Today's was a disaster. It's why the market closed down 800 points at the end there from being flat. All that happened within like a couple of hours, by the way. That's how much of an influence the bond market is. So yeah, that's really all I got to say on that front. I will say this: I am a happy camper. My Cubs in the first month of the year had statistically the toughest schedule on paper that any team will have all year. We came out of that in first place. We've had a lot of injuries to our two biggest starters are hurt. Our closers hurt for like a month. And despite all that, we're in first place and pushing through and getting it done. So I'm happy when it comes to my Cubs. I'm healthy. I'm thankful. And believe you me, we'll be watching these markets like a hawk to make sure that, not just that we're positioned correctly, but that if we have to lighten up and get a bigger cash position, just in case that we have that to take advantage of a potential dislocation in the overall markets, which can spill over to all markets if people get margin calls, right?
I was going to say you had the papal blessing, but I think he's a White Sox fan and not a Cubs fan. And yeah, we get it from the Boca del Caballo, right? The Caballo Blanco, Caballo Negro, all the caballos, Gerardo. You know some of those.
Indeed. Anything to add, Mr. Hodge?
No, let's get into the premium portfolio picks. Hope everyone has a good Memorial Day weekend.
Have a great one, everybody. I am Gerardo Del Real, along with Mr. Nick Hodge. This was the 318th episode of our weekly therapy session we call Investing in Bizarro World. Hope everyone has a phenomenal Memorial Day, folks. Ain't free, it's earned. Act accordingly, regardless of partisan stuff. Adios, y'all.
See ya.